Uh, Good evening and welcome to today's session. Right, today we would like to look at the different types of taxpayers that we mainly deal with in our modules. You would find that there are various different taxpayers that we face. We have the obligation to pay tax to SARS. So, I want to look at those different taxpayers uh, so that we can note there are different tax reporting and there are different tax tables, right? So we want to know the general information about the different taxpayers that we have, right? As collect tax from different taxpayers, from individuals, uh, where we have got businesses, and we should know that in this module, our main focus is businesses, right? A So we've got different businesses that can pay tax. So traders, partnerships, close corporations, companies, trusts, farmers. Right. Then some of those businesses above can also be called small business corporation. For example, we can have a company being termed a small business corporation or a company being termed a micro business. And when they are classified as such, or when they qualify to be classified as such, they will have different tax regimes that they will be liable for. So those are the things that we want to look at during our class today. Right. First of all, we've got a sole trader. A sole trader refers to a business that is owned and managed by a single individual. You would find that this individual uh, is regarded at law and for tax uh, as the same as the business. Right. So that means the business does not pay tax separately. The business of a sole trader does not pay tax separately. Right. So if you are Mr. Motaong and you operate a business, which is a sole trader, you don't have to pay your own tax for your income and then pay the tax for your business separately. But you have to report the income that you are getting from your business on your own personal return as Mr. Simon Motaong. So on your personal return as Mr. Simon Motaong, you report all your income. It can be rent that you are getting from properties that you are renting out, the interest that you are getting maybe from investments that you made, then the profit that you are the income that you are getting from Motaong and Sons as your sole trader business. So you report all those that income and expenses on your personal return as Simon Motaong. So there's no need for you to say one return from Simon Motaong and another for Motaong and Sons. That one return will have all your income. So we're saying a sole trader does not have is not a separate taxpayer. So the legal way is also regarded for tax. So for a sole trader, you have to declare your tax that you get from your individual operations and declare it on your income tax return. So if you've got your business that you are operating, when you are declaring your tax, including your salary, you should also include the money that you are getting from your tax shop. And normally, if you're operating a business, you should also include the deductions or expenses that you are paying for that shop. That's a sole trader. Any questions on the sole trader as a taxpayer? Right. Then we've got a partnership. A partnership is a business that is operated by 2 up to 20 people for the sake of making a profit in an unincorporated manner. So it's not an incorporated business. Right. Again, for tax purposes, a partnership is not a separate taxpayer. So if you are in a partnership with your friends, you don't have to say a you don't have to do a tax return for that partnership. But each partner should declare their share of profits on their individual tax return. So each partner should report for tax on their portion of that business on their own personal tax return. So a sole trader and the partnership are the same in that the tax is the individual owner is liable for tax in their individual capacity, not in the business capacity. So you find that if you're a partner, you declare your profits on your personal return, and then you'll be taxed as an individual. So if Charles, Tom are in a partnership, Charles will just declare on his personal return his own tax and pay his tax as an individual. Tom will declare his share of the profits on his personal return and pay his tax as an individual. Right. Any questions on partnerships? But you know that it's different for VAT. For VAT, a partnership can register as a VAT vendor, as a business. Right. Now, if you are an individual, you pay your tax according to the tax rates of individuals. You'd find that unless told otherwise, during the current year, we'll be using the tax rates for the 2023-2024 year. We'll be using the tax rates that expired in February, that are expiring this February, most probably in our studies. We will not be using the current ones, which will be for 2024-2025. Right. Tax tables. Right. For individuals, these are the tax tables. That means if you earn 1 rand to 237,000, you pay 18% of your taxable income. 237,101 to 370,500, then you pay 42,678 plus 26% of taxable income above 237,100. If you then from 370,501 up to 512,800, you'd pay 77,362 plus 31% of taxable income above 370,500. On and on until someone who earns more than 1,817,000, they will pay 644,489 plus 45% of taxable income above 1,817,000. Those are the tax tables for individuals. So that means if you're a partnership or a sole trader, you have to declare your tax as such. Mr. Andy.
Thanks. Just for interest's sake, can you just clarify these amounts? We can take anyone. So we can take maybe the first bracket for 42,678. So when you say, so let's assume somebody earns 300,000. So are you saying from the 300,000, we minus 42,000, then we will then work 26% there? Or is that what you're saying there? Or what are you saying? Can you just clarify that?
That's what I want to clarify down here.
Oh, okay, no, it's fine.
So here I have a question here, which asks you, we have here a taxpayer called Eugene Kazalika, who you have to calculate the normal tax liability, considering that their taxable income has been determined by SARS to be this. So that's what I want to show here.
Oh, okay, no, that's fine, because it was actually confusing a bit there. Okay, it's fine.
No, yeah. The tables, I give the tables, then below I give you examples of how to determine that tax.
Okay.
Right. Okay, sir. Thanks, sir. Right. So when you see the income, of course, when it comes to individuals, they will be, after determining the tax, they will subtract what we call rebates. Then they can also be medical tax credits, but we don't mainly deal with them in this module. We don't do much on them. There are very, very few things that we'll do, which I will show you, which are necessary for this module. Right. So now, if the person earns 250,000, they fall in this bracket here. Right. So their tax they will pay a 42,678. Then on top of that 42,678, they will pay an extra tax on their income above 237,100. So they will now say the 250,000 minus 237,100 multiplied by 26%. So what we are saying is if you earn 250, you pay this 42. 42 is your minimum tax that you're going to pay. 42,678. That's the minimum. On top of that, you then pay 26% of all your income above 237,000. This should be 237,000. Sorry about that. So above 237,000. That's 100, 237, 100. This is 101. Okay, that's fine. Right. So what do we get here? Can we please quickly calculate that tax? Let's try to use our calculators first. Can you please help us, guys, so that we can be faster? Otherwise, we'll be stuck.
I'm not sure if I calculated correctly. It's 380.
It can't be 300. Okay, the best way to do it, my sister. The best way to do it, can you say 250,000 minus 237,100 first?
Is it 237 or 237,000?
237,100. Yes, it has to be 237,100.
It will be 12,900.
Then times 26%.
And 26%. 3354.
Then add the 42,678.
4632.
46 what?
46,032 rands.
032.
Yes.
Okay, so that's how you determine the tax for that. So this one, the amount written will be the minimum for that bracket. Then on top of that, you then pay an additional tax on your additional income above the previous bracket. Right. So now if the person earns 520,000, we know that 520,000 falls in this bracket. 520,000 falls in that bracket there. So that means there will be 121,475 plus then we find the difference between 520,000 minus 512,800. Then multiply this by 36%. What do you get? Can you just use the same method so that it can be easier?
It's 124,067.
Right. Then if the N970, the 970 will fall in that bracket there. The 857,901 minus 1,817,000. So it will be this one here. Right. So we would say 251, 258 plus 970 minus 857 900. Multiply by 41%. What do we get?
It's 297,219.
297,219. Right, and then finally on D, it's 1950, which is in this bracket here. So it will be this one. So it's say 644, 489 plus 1,950,000 minus 1,817,000 times 45%. What will we get?
Seven zero four 339.
999.
704,339.
Thank you so much. So this is how we determine the tax of individuals. As I said, there will be an issue of normal rebates, an issue of tax credits, which we don't do now. Mr. Andrew.
Thank you. Thank you. So if, for example, then you're earning 250 per annum, so you're going to pay 46,032 rand per annum. And you're anticipating that perhaps come here and let's say you're from January till December, you're anticipating that maybe December you're going to get bonuses. And you want, maybe the bonus will be maybe 1 month full pay. So that would be an additional income that we would have received.
Remember, when they calculate that 250, they will have included all your income, including bonus.
Oh, okay. So now,
when they include your income, they include your rent that you receive from your properties, your interest that you receive from your other investments, and all those things.
Also, they've already taken consideration of the bonus there.
Yes, because here I'm saying this is the assessed, SARS has already assessed you, they've calculated and they've said all your income from all your sources is this much for the year.
Oh, okay.
But when we do the tax for individuals, that will be done in tax 1501. That's when we have to do these things of determining maybe your monthly tax. That's when you have to take into account that the month that you earn a bonus, there will be adjustments that will be done for those months that you don't earn a bonus and stuff like that.
Oh, yeah. Because
you are breaking. Mr. Andrew, you are breaking. I've lost you, Mr. Andrew. Maybe I'll get his question when he rejoins. Right. Then companies, these are businesses that are registered in terms of the Companies Act 71 of 2008. You'd understand that
then make provision.
I can't hear you. I think Mr. Andrew, I think I'm losing him there. Right. So I was saying that a company is registered in terms of the company's X71. Now, a company, unlike a sole trader and partnership, is a separate legal entity, and it is a separate taxpayer. A company on its own pays tax. It has to submit its tax return through the officials of the company. So a company is a separate taxpayer. And this company will pay tax at a rate of 27% of the taxable income. So 27% of what they call the taxable income. So that is the tax rate. When a company declares dividends to the shareholders, they will be required to withhold what is called the dividend tax of 20% if the dividend is payable to individuals. But if they are paying to South African listed companies, there will be no withholding dividend tax, as the South African companies are exempt from dividend tax. So a company will do its return. And you should know that for individuals, the tax year is always March to February. That's their tax year. But for companies, the tax year can adopt the financial year of the company. So another company's financial year can be January to December. Another one can be May to April. Another one can be July to June, on and on like that. So it normally takes the financial year of the company. Right. So at the end of each financial year, they submit a tax return. But of course, during the year, most companies are normally required to pay what is called a provisional tax, an estimated tax. So at the end of the year, when they verify their tax, they will now just subtract the provisional tax they will have already paid to determine the final tax. I think that's what we'll be doing maybe in our next class, whereby we'll determine the provisional tax that the company has to pay and also determine the final tax liability. So we've got different companies, we've got public companies, and we've got private companies. Public companies are those that can sell their shares on the Johannesburg Securities Exchange, whereas private companies cannot trade their shares on the Securities Exchange. Right, for tax, a closed corporation, which is registered in terms of the Closed Corporations Act 69 of 1984, is just regarded as a company. When we say it is regarded as a company, that means the same provisions that apply to a company also apply to a closed corporation. So a company is a separate taxpayer from the individuals, which is to submit its own returns, whereas the individual owners are also separate taxpayers who also have to submit their own returns. Any questions on this company? Right. A company can also be what you call, if it qualifies, it can register as a small business corporation. Now, when you register as a small business corporation, your tax rates are different. They are slightly lower from the other companies. Like it's a relief to the smaller companies to reduce the tax burden on them. So only for those businesses that qualify as a small business corporation, we're going to look at them. So we said normally a company is 27%, but if a company qualifies as a small business corporation, these will be the tables. There will be a sliding scale. 0 to 95,750, it will be 0%. 95,751 to 365,000, it will be 7% on income exceeding 95,750. Right, on and on like that. So how do we determine the tax of a small business corporation? Right, so if they earn 50,000, it is within the 0 to 95,750, therefore tax will be 0%. So it will be 0. Because taxable income is below the minimum threshold of 95,750. So any small business corporation that earns less than 95,750, then they will not be paying any tax. Right? If they earn 270, they will fall in this bracket here. That means they will pay 270,000 minus 95,750 multiplied by 7%. What do we get? What do we get?
12,197.5.
198. So just round off to 198. Is that right? Right.
Okay.
Then this one is 440. It will fall under this bracket here. So if it's 440, it will fall between the 365,000 and 550. So they'll pay a minimum of 18,848 and an additional tax on the income exceeding the 365,000 who attracts a tax of 21%. What will they pay?
$34,598.
Exactly 34,500.
84,598.
You said
34.
598.
Yes, 598 at the end.
Thank you. Then if they earn 800, they will be in the last bracket here. So they'll pay the minimum 57,698 plus 800,000 less 550,000 multiplied by 27%. What do you get?
$125,198.
Right. So this is how we determine the taxable income of a business, a company that qualifies as a small business corporation. Right. A business. So this is for businesses that qualify as small business corporations. Right. A small business corporation, how do they qualify to be a small business corporation? It can be a closed corporation, a cooperative, or a private company. Right. All the shareholders should be natural persons. So all the shareholders in that company should not be institutions. So there should not be another company holding shares in that company. All the shareholders should be natural persons. The gross income should not exceed 20 million. Their gross income should not exceed 20 million. When we say the gross income, we mean the income before deductions. They should earn less 20 million or less. None of the shareholders or members of the small business corporation at any time during the year of assessment holds any shares or has an interest in the equity of any other company other than certain permitted investments. So they should not have any investments excluding the ones that are given here. These will be the permitted investments. So they should not have any other. So that means if they have 5% or more in a social or consumer cooperative, then they do not qualify. Right. Then their investment income and income from personal service should not make more than 20% of the revenue. So if their investment income is more than 20%, they don't qualify to be a small business corporation. And what is investment income? Investment income includes things like rent. When you've got properties and you are renting out, you get rent, interest. You invested your money, you are getting interest, royalties. You have rights that earn you royalties, dividends, and other similar income. So if these make up more than 20% of your revenue, then you cannot register as a small business corporation. Right. Personal service, that's service that is provided on a personal level. So as long as personal service, also like accounting services, consultants, is more than 20%, then you cannot qualify. Right. They also have special allowances. This one we shall do it at a later stage when we do later topics. Close corporations also have special allowances which they earn by virtue of being close corporations on assets which are not available to other companies. So they have special allowances which they are granted, special deductions which reduce their tax burden, which they earn by virtue of being small business corporations. We'll do this at a later stage when we do I think after our next class, when we do the determination of the tax gross income and stuff like that, that's when we'll be able to learn all those things. Any questions on small business corporation? Right. Smaller businesses can also qualify to be classified as micro business. These are very small businesses. Now you'd find that micro businesses, they even have lesser tax brackets. So the reason why these tax concessions are there is to promote smaller businesses so that they are not taxed the same as bigger businesses, because they can't compete with bigger businesses. Their scale of operations is too low to the extent that if we charge them tax the same way that we do bigger businesses, then it can be very difficult for them. Right. So what is a micro business? It's any natural person, company, or close corporation whose qualifying turnover does not exceed 1 million in any given year of assessment. So the qualifying turnover should not be more than 1 million. As long as your qualifying turnover is more than 1 million, then you cannot qualify as a micro business. You cannot register as a micro business. Right. So as long as you qualify, then you can be taxed on a turnover tax system. Now, if you are taxed on a turnover tax system, you will not be taxed on the taxable income, but you'll be taxed on turnover. You'll be taxed on turnover. Right. What is qualifying turnover? Right. Qualifying turnover refers to the amount received by a business in a year of assessment from carrying on business activities. So the amount that you actually received from doing your business. When you were selling goods, the amount that you received. So if you sold on credit and you have not yet received the amount, you don't include it in qualifying turnover. Qualifying turnover only includes amounts that have been received. right? But it excludes amounts of a capital nature. When you sell a capital asset, for example, you sell a building or you sell property, plant and machinery, you sell your motor vehicles, which we're using in your business, that amount will not be included in the qualifying turnover. Only when you sell these things that you sell on a day-to-day basis, if you have a shop, things like groceries and stuff like that. Right, certain government grants are not included in the qualifying turnover. So in our exams, there's no problem. They will tell you that these grants are not included. All right. Amounts received from small business funding exempt from income tax, they will also not be included. Right. Now, the 1 million threshold should be proportionally reduced if business was carried on for less than a year. That means, let's say, if you started your business in August, remember, right, a micro business year, financial year should always end in February. So if you started your business during the year, your threshold for determining whether you qualify or not will be apportioned according to the months. Right. What do I mean? Let me just give you an example. ABC traders started trading on 1 April 2022. Right. A micro business financial year starts in March. So if this business started in April, that means it only operated for 11 months. Remember, I said that the financial year of a micro business always ends in February and starts in March. So for the year ended 20 February 2023, they only operated for 11 months. So when we're determining whether they qualify or not, right? First of all, we have to determine their qualifying turnover. Remember, qualifying turnover is amount that you received. So you don't just take the sales. You take the sales if you are told that they were all cash sales. Qualifying turnover refers to amounts received. So if there are any credit sales for which the company did not receive the amounts, those credit sales should not be included in qualifying turnover. So when you are looking at a micro business, if you are told that these were the sales, before you conclude that they are part of the qualifying turnover, check if they are all cash sales. Right. Then we are told that cash received for the sales was 800,000, whilst the remaining 180 was still owing at year end. So the 180 is not included in qualifying turnover. Qualifying turnover refers to the amount that you have already received. So the qualifying turnover is 800,000. The business also sold some damaged furniture for 50,000. Right. We should know that furniture is a capital asset. And proceeds from sale of capital assets are not included. Qualifying turnover. Right, capital assets, we're looking at those from an accounting point of view, the non-current assets that you normally use to generate income over a period of more than a year. Things like land and buildings, motor vehicles, furniture and plant and equipment, furniture and stuff like that. So although they may have received the 50,000, but it is not included in qualifying turnover. So their qualifying turnover will only be the 800,000, which is the part that they received from their sales. Right. Now to check if they qualify as a micro business, remember, for you to qualify as a micro business, your turnover should be less than 1 million in a 12-month period. But here we don't use 1 million as the threshold. Why? Because they only started operating in April. So their year was April to February, which was 11 months. So we have to calculate their threshold. So their threshold, it would be 1 million times 11 over 12 because they operated for 11 months. So we no longer use their 1 million. Instead, we use the 916,667. So considering that their qualifying turnover of 800 is less than the 916,667, then this business can register as a micro business. So as long as your qualifying turnover that you received is less than the threshold is determined, then you can register as a micro business. The advantages is you pay lesser tax, as you will see later. So the qualifying turnover, the threshold is 1 million, but if you operate for less than a year, you have to calculate a new threshold. Any questions? Right, there are businesses that are not allowed to register as a micro business. Any persons who hold shares or interest in a private company, close corporation, or cooperative. So if you hold shares in another company, your business cannot be regarded as a micro business. But if you have shares in listed companies, portfolios in collective investment schemes, both corporate and share block companies, if you have in any of these, then you can be allowed. You can still be allowed. Right. A person for whom more than 20% of the receipts are investment income and professional income. I think I talked about what is investment income. We said rent, dividends, interest, and stuff like that. And what is a professional income? What looking at the income that you earn for providing a professional service, accounting and stuff like that, teaching, consulting and stuff like that. So as long as more than 20% comes from that, then you cannot register as a micro business, just like a small business corporation. A personal service provider or labor broker, they cannot qualify as a micro business. If you have got capital receipts in excess of 1.5 million over 3 years, so if you sold assets like vehicles, furniture, buildings, for which resulted in you receiving more than 1.5 million over the past 3 years, then you will not qualify to register as a micro business. Right. Certain companies which are specified in the Act, we don't normally go deeper into that. A partner in a partnership, where any of the partners in the partnership is not a natural person. So even if you're a natural person, but one of the partners is not a natural person in your partnership, then you will not qualify. Right. Now, taxable turnover. Okay, we talked about when we are calculating the qualifying turnover, we are just checking if you qualify to register as a micro business, but that's not the amount that they will charge tax you on. They will tax you on. So the qualifying turnover is just there to determine whether a business qualifies to be registered as a micro business. Right. After qualifying, then we have to calculate your tax. Your tax is calculated on what we call taxable turnover. Taxable turnover, it's amounts that you received during the year which are not of a capital nature. Plus, now we include 50% of your capital receipts. So you should be very careful there. When determining the qualifying turnover, we don't include capital receipts. But when determining the taxable turnover, we include 50% of the capital receipts. So let's say you sold a vehicle for 500,000. When we are determining whether you qualify as a micro business or not, that 500,000 is not included. But when we now determine your tax, 50% of that 500,000 will be included in your taxable turnover. Right, 100% of investment income of companies, close corporations, and cooperatives. The 100% of investment income only applies to companies, close corporations, and cooperatives. Right. If it's a natural person, a sole trade, and a partnership, 100% of investment income is not included. Right. Let me just show an example. We have ABC traders started trading on 1 April. During the year of assessment, the business entered into the following transactions. Right, total sales were 980. Cash received from the sales was 800,000, while the remaining 180 was still owing at year end. The business also sold some damaged furniture for 50,000. The taxable income. Right, the taxable income will include the cash received from sales, which is 800,000. Right, and the capital receipts, it will only include 50%. So 50% of the 50,000, this one will have 25,000. So the taxable turnover would be 800 plus 25,000, which is 825,000. So the tax will be paid on 825,000. That is the cash received plus 50% of capital received. Right, how much tax will be paid? If it's 825,000, we'll go on the tables. We'll find that 825,000, these are the tax tables of a micro business. Right. You'd find that 825,000 falls in this bracket. So that means their tax will be this one. So it will be 650 plus 825,000 minus 750,000 times 3%. So as you can see, their tax rates are lower. What do you get?
8,900.
It's what? 8,900.
8,900. 8,900.
So this is the tax that they will pay. So you see that there's a relief, because if it was a company, it was going to pay 27% of 825,000. Any questions? So these are the different types of taxpayers that we can have. So you have to know how to calculate the qualifying turnover, how to calculate the taxable income of micro business. You have to know which types of businesses do not qualify to be a micro business and which ones do not qualify to be a small business corporation, as we did, as I said earlier on. And you have to know that if it's a small business corporation, there are different tax tables. Any questions? Right. So if we don't have any questions, then we'll meet next week. Thank you so much, and God bless you richly.
Thank you.